We've got, the different inflationary forces that are coming into play. So how are you seeing that struggle sort of play out?
Yeah, I think you put it really well. That basically there's two really powerful forces there. I mean, on one hand, you have deflation, you have aging demographics, you have technology, you have offshoring, all these different levers that make things cheap and that basically can slow down growth and basically suppress wages and keep inflation at bay. On the other hand, we have, if you look at the types of inflation, there's a big difference between what, say, commodities have been doing, before last year compared to, say, healthcare costs. Healthcare costs in many countries, especially the United States, we actually have the highest healthcare costs in the world down here. But basically, there's just so many forces on either side. And that was, the case back, in the previous long-term debt cycle as well. So the previous time we had the ending of a long-term debt cycle was the 1930s. And then it was bleeding into the 1940s, and they had a very similar environment there. So the 1930s were extremely disinflationary, and it was only because of this massive policy response as well as external factors that you got that more inflationary kind of rebound out of it. And so we're kind of seeing a similar thing now, where the 2010s in many ways were very disinflationary. We had a period of commodity oversupply, so most commodities were cheap. That helped keep a lot of kind of basic pricing down. We had a lot of outsourcing, so things like electronics and apparel kept getting cheaper and cheaper. And the real kind of worries were the services sector. So anything where you're paying someone to do something, essentially, whether it's education or healthcare, or even things that are unrelated because you're paying for their, if you're hiring someone to do something for you, you're basically paying for their high healthcare and their high educational costs as well. And so those areas were the part where we actually saw some actual price increases. But going forward, especially as we saw over the past year, the major tools that the policymakers have to combat inflation to combat deflation and create inflation can become increasingly aggressive as some of those other tools, basically fail to work. And so a lot of people thought, a decade ago that quantitative easing would be inflationary. That was kind of the narrative back then. But what we saw last time, as well as the previous time in history when that was done, is that basically increasing, the base money is not very inflationary because, you're not necessarily increasing the broad money supply. You're not getting money into the hands of people. You're not having more money chase fewer goods. And so there's no real reason for it to be inflationary. At best, you can call it anti-deflationary in the sense that it prevents a bank collapse or things like that. But it doesn't really just result in what we generally think of as broad inflation. However, if you directly increase the broad money supply by quite a bit, through massive fiscal spending that is in large part monetized by the central bank, which is very different than what happened a decade ago, then you're more at risk of inflation. It's still not guaranteed because you still have to, you have to compare the magnitude of that increase in the broad money supply compared to the various factors that are disinflationary and that press down on monetary velocity. But overall, at least now you're in the game. Now kind of inflation really is an option on the table, and it becomes this tug of war between two forces. And so when I'm kind of looking out for potential inflation, what I'm most paying attention to is the fiscal spending that's happening, and then how is that fiscal spending being financed? Is there real investors buying the bonds, or are a lot of the bonds being bought by the banking system and the central bank? And then, indirectly, then you can then watch the broad money supply go up, and then see, is most of that pooling in the upper classes, or is it getting widely distributed? Because again, part of the reason why some of the increases over the past decade have not been very inflationary is because we've actually had a pretty substantial wealth concentration, and so a lot of that money kind of wound up in the top 10% or so, and therefore it winds up in financial assets. Rather than in consumer goods. And, I guess the last point I would talk about is that a lot of economists, when people are talking about inflation, most people having that debate are looking at it from an economic perspective. And I rarely see them talk about the commodity cycle. So if you look back in history, we have this, roughly 15-year commodity cycle. It varies. But basically, you have a period of strong demand. Commodity prices are high. That encourages a lot of producers to come and create new supply. Build new mines, find new reserves, whatever the case may be for that particular commodity. And then some sort of slowdown happens, or just the sheer amount of new supply coming into the market kills the prices, and then you're left with a period of oversupply. But because a lot of those mines, like a copper mine, takes a very, very long time from finding the reserve to basically making an outputting mine. The same thing for a very big oil discovery, or whatever the commodity and case may be. There's that giant lag time, and so when you have that period where you're oversupplied and prices are low and it doesn't justify new sources coming online, that kind of sets the stage many years later for that inevitable bull market in commodities because you haven't invested enough. And so it's important that this disinflationary period that we've had over the past 10 years has taken place during a time of commodity oversupply. This started, ever since about 2008, and whereas now it looks like in some ways that might be coming to an end, especially when you look at the copper, where that is, because there's not a ton of new supply there. We have a pretty big forecast for higher demand in the decades ahead, and then even with energy, which has been the most structurally oversupplied area, we've actually had pretty weak capex for several years now, and then of course 2020 killed a lot of the capex. And then we combine that with the fact that with ESG mandates, some of the financing that, for example, has financed unprofitable North American shale oil for the past decade is not really there in the same way that it was maybe 5-10 years ago. And so we have a couple kind of variables coming together that potentially makes the 2020s a little bit more inflationary than I think consensus would expect. But it's still that hinges on basically the policymakers are likely to continue doing larger fiscal stimulus than people expect. And so that view can always change if you were to get a sharp change in fiscal monetary policy.
So you're getting kind of the double whammy of the supply push inflation and the demand pull inflation, right? As maybe demand stays the same, but you're having a lack of supply from commodity producers, and you have this massive fiscal stimulus that, if done right, it goes to everybody's pockets. And these are consumers that are going to spend most of the money that they get versus the upper echelon, mostly just hodling it, putting it into their investment accounts and real estate prices, right? So it seems to be like an interesting pivot point from an inflationary perspective. It could always change, of course, depending on how things turn out. But it is something that I think investors. I just saw a poll recently of the amount of consumers that are worried about inflation, and it was like 75%. I don't remember the last time that I saw something like that. Of course, that's the macro side of me makes me feel like I should take the opposite side of that trade.
Yeah, I think it's one of those. It's
you're still watching though, right? You're not taking any hard positions. What are you seeing, and when does this play out?
Yeah, I mean, I often tilt my portfolio rather than go all in on an idea, and so I have been tilted towards this reflationary idea, and then the question is how long to press that, how long to keep pushing that. And for example, I've already dialed back some of the things, like for example, copper stocks went straight up, and so kind of dial back things that might be a little bit overdone. But overall, I still have a reflationary tilt to my portfolio. And some of the things I'm watching, I mean, there's kind of the near term and then the longer term. So the near term is we're going to have attractive base effects in the next few months. And so, when inflation is discussed, what you're generally talking about is the year-over-year consumer price index, or a couple other ways to measure it. So if you look back last year, the lowest points, for the CPI were that April and May period, at least for the United States. But I'd assume that would apply for most of the rest of the world. And so when you're comparing year over year, back when we had the data point from February, but the February of 2020 was still pretty high back then, and so that year over year comparison was still somewhat tough. But when you look out to the April and May periods, that year-over-year comparison is very favorable, and so you're likely to get a somewhat high headline print. It could be comfortably 3% or more, just based on basic CPI kind of maintaining its mild upward trend now, and then you could get notably higher than that if that doesn't become as transient as people think. So basically, the deflationary case would be okay. You're going to get the base effects, and then it's going to wear off, and you're going to go back to normal, and it's going to basically, all of that inflationary force is going to get eaten by the larger deflationary force. The other way of looking at it is that they're already talking about more stimulus. They're talking about the potential for a $3 trillion infrastructure bill, and that can keep that going potentially for longer than people expect. And as far as people saving it, it's kind of a spectrum, right? So we actually have seen increased saving, and that's why even though we increased broad money supply by something like 27% year over year, we of course haven't seen 27% average price increases. Maybe in commodities we have, ironically. I mean, many commodities are up that far, but broad products are not necessarily up that much. In large part because if you look at, say, personal income in the United States, you spiked above trend, right? So even though we're in a giant recession, people on average had more income than they otherwise would have had. But at the same time, they're barred from spending it, right? So they can't travel as easily or as comfortably. They're not doing business travel as much. A lot of expenses that they otherwise might have had are on hold, and as a natural result, a lot of them have saved it. They've deleveraged a little bit. Or they've shifted their spending towards things that are inherently cheaper and more deflationary, like technology, basically, more streaming packages but less gasoline consumption, for example. But as that starts to end and consumers have quite a bit of excess funds, that can move back into the real economy. And so it'll be inflation is one of those things that does have a qualitative component to it, because once people expect that their money is going to not be as valuable 6 months, 12 months from now, they're more likely to spend it. Whereas if they have the perception that prices are going to stay flat or even go down, they're more likely to wait for certain purchases.